Interest rates have risen yet again. I'm going to break down exactly what this means for you, the individual. We're going to talk about mortgages and, of course, what's happening with the economy. First things first, we'll look at the Fed. I'm going to explain everything you need to know, including historical examples. And then the second thing is to do with what's happening with these economic headwinds that are coming through. You don't want to miss it. Let's begin. Here is the press release coming directly from the Federal Reserve's own website. Every time they have their meeting, you get this at 2 p.m. and then at 2:30, Jerome Powell takes questions from the reporters. I listened to the questions and of course I saw the statement, and the statement shows exactly what we've been expecting. No surprises here. It's that the Fed funds rate is between 4.25% to 4.5%. It's always within that range. And this was the result of a 50 basis point rate hike, which is 0.5%. So now we are at the top level of 4.5% on the Fed funds rate. Haven't been there in many years. If you're questioning what the heck is a Fed funds rate, what's the Federal Reserve even, and what does it really mean, stick with me. I will break that all down for you here. But essentially, interest rates are higher, and that means your borrowing costs are higher as well. And there are many things that were said during the reporters asking questions, and essentially I found that none of them, for the most part, were really useful to you. And that's unfortunate because these reporters are really just there to give out some softball questions and never really pressing anything. They always ask almost entirely the exact same question every time. And so Powell just reads off the piece of paper and the same words and the same statements are said and you get nothing out of it. I mean, it's terrible. That's my job. My job is to make sure you don't have to waste your time, okay? I sit there and cry so you don't have to. Let's look at this. You could see Powell says a soft landing is still possible. No, I wouldn't say that. I don't say that. To the extent we need to keep rates higher and keep them there for longer, I think that it narrows the runway of the soft landing, but lower inflation readings, if they persist in time, could certainly make it more possible and so on. So he's essentially saying, don't worry. Yes, we are increasing rates. It's not going to cause a problem. Very, very small issue. You don't have to worry about it. This is basically talking about the fact that we haven't had confidence on what's going on. Look, recent signs of slowing inflation have not brought any confidence yet that the fight has been won, Powell told reporters. And you see that this is actually prior to the meeting. And of course, they needed to mention this. And of course, they will be continuing to mention this in all of the, from here until the next meeting, which is February. They're going to have to mention these things because they want to make it seem as if they're being very tough on inflation. This is one point that I wanted to make, and that is services outside of housing, quote, may be the most important category for understanding the future evolution of core inflation. That's what they look at. They look at the core inflation, okay? That's Jerome Powell. That's what he said. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. So indirectly, what Jerome Powell is saying is that you need to experience higher layoffs and less total employment in order for the job to be done. Because inflation will remain high unless you can have some more problems in the economy. This is what they're trying to create. Unemployment is still, what they say, too low. And as a result of that, inflation is going to remain high. They need to remove this, and they can certainly do it by keeping interest rates too high for too long, in their words anyway. Here's what the Fed interest rate hike means for businesses' debt and cash flow. Like I have explained many times before, when you see what a business does, they expand using debt. Apple may hold $200 billion in cash or cash equivalents, and yet they are going to borrow money. Why would they do this? It's because it's advantageous to them, believe it or not. The Federal Reserve raises benchmark interest rate by 50 basis points, which sends small business loans to the double-digit percentage range for the first time in decades. Small business loans are based on the prime rate, which is now 7.5%, as the highest since 2007, and pushing most SBA loans to a 10.5% interest rates. Now, of course, that means on one hand, people are not going to borrow, businesses are not going to borrow unless they're very confident. Or in some cases, they're pushed to the edge and they need that. But if they're not very confident, they're not going to borrow, and then you have less overall risk. That's what this does. Higher interest rates can be a very good thing for the economy because they protect from the risk taking. When you drop interest rates down to zero, you run into some issues. That's the key thing, okay? Bill Ackman, your friend, Bill Hell is Coming Ackman, said that the Federal Reserve's 2% inflation target is no longer credible. We can't do this anymore. And essentially, he makes the case for a 3% inflation target. Who knows? By then, it could be 10%. And other central banks are doing the same thing. They're still increasing rates. I wanted to show you this example. Hong Kong central bank interest rate hike after the Fed hike, and you could see that others will do the same thing. We know that. We know that they will increase rates at least for now. Now, this is Bill Dudley, and I wanted to show you the quote and what he said. If you look at what Powell said and what the projections were, those were hawkish remarks and hawkish projections. So you have the former New York Fed president saying Powell's trying to be tough. And yet the market is not going to perceive it that way. The market is desperate. The market needs more juice, baby. Let's get it going on. Well, I want to explain to you what this all means. What's the Federal Reserve doing and what they've done before. The Federal Reserve is the central bank of the United States. It is responsible for managing the nation's monetary policy and for ensuring the stability of the U.S. financial system. In August of 2007, the Federal Reserve began to raise interest rates in an attempt to slow the growth of the economy and ward off inflation. This was done by increasing the federal funds rate, which is the rate banks charge each other for overnight loans. The raising of interest rates was designed to make borrowing more expensive and reduce consumer spending, which was thought to be one of the main causes of the rising inflation. However, by the end of 2008, it had become clear that the US economy was headed for a financial crisis, and the Federal Reserve began to cut interest rates in an effort to stimulate the economy and encourage banks to lend money. The Federal Reserve cut the federal funds rate from 5.25% in August of 2007 to a low of 0.25% in December of 2008. Alan Greenspan, the former chairman of the Fed, said at the time, quote, "The risk of an impending recession, however, has clearly risen. We must not and will not stand idle." The financial crisis had a huge impact on banks and insurance companies. Banks became unwilling to lend money, and insurance companies saw their investments decline in value. This caused many of them to become insolvent, resulting in massive losses and a need for government bailouts. If you were around during that time or you've read the books, you know what occurred. That was the history in that previous cycle, and now we are about to enter this era. This is a new era, a new time in which we will see some of the same patterns forming, and I'll give you one of those right now. We'll look at the Chinese first, however. US to add more than 30 Chinese companies to the trade blacklist. Economic headwinds are here. I'm showing you this. Talked about it in the previous videos. You've got other countries joining along saying we do not want to sell semiconductors or the technology to Chinese companies. Why? National security, they're saying, and they basically don't want them to get ahead of where the US is right now. So now we are expanding that. It's going further. The tensions between both of these sides are a problem. It's never a good thing when you're not working together, and unfortunately, we see more of that. Health insurance is helping cool inflation, but, quote, it's not a very good reflection of what people pay. And I wanted to bring this up because you're going to get these inflationary figures coming out everywhere, and it doesn't really tell the whole story. This is just one example. But the point here is that we need to look at what our inflation rate is, but at the same time understand that all of this, all the information we are receiving is something that we should take with a grain of salt. We don't necessarily need to believe that the inflation rate is 7.1%. It doesn't really matter. Let's not focus on that. Let's try to utilize the information we are given and say, well, if they're saying that it's this and that wages make up the largest percentage of the inflation, of core inflation, well then let's pay close attention to that, because it's going to tell us what's happening. And if companies are dealing with stress and they become insolvent, you've got bankruptcies and you've got crises, well then they're going to have to lay people off. That changes the employment factor, and that's going to affect core inflation. I hope you're with me on this. I'm giving you the details right here. UK company insolvencies rise by a fifth as economy struggles. Here we have it. This is important. The UK dealing with this right now. Look at it. You could see it for yourself. They give you the numbers. The whole point here is that, of course, you're going to have economic issues that arise as a result of increasing interest rates. You got supply chain problems and all the rest. This is the same article from the previous one. And then this is basically just talking about what's happening Shanghai and other areas. And this is Beijing, but Shanghai, Beijing, they lifted the restrictions and lockdowns. And you could see perhaps in this image here that the streets are pretty empty. Well, what happened? Well, it turns out that people are now not really willing to go outside if they don't have to. Do you see what's happening here? This is something that in the economy, I believe I have some stats for you here, that could persist. This could be a problem for the foreseeable future. Take a look at what happens with inflation, with the supply chain issues. Inflation can remain high if there are consistent supply chain issues due to the disruption in the flow of goods, services, and money. This can be caused by geopolitical tensions between the US and China, for example, such as tariffs or trade wars, which lead to a decrease in supply and an increase in prices. Additionally, bankruptcies of businesses due to the economic fallout, which can lead to fewer companies competing in the market and fewer goods available, can also contribute to higher prices and higher inflation. I am interested to see what happens here, but I just wanted to break it all down for you, and that is that. I think it's important to follow the history, to see what's happening, then to break down the individual issues, and we can kind of paint the picture. I hope I did that for you. If you found value in this video, you hit that subscribe button, and I'm going to bring you a new video tomorrow, and it's going to be jam-packed. This is the kind of detail you need to know, not this, yeah, it's 50 basis points. That's fine. But we need to understand what it all means. I hope that I did that for you. If I did so, just please click that subscribe button, and I'll see you tomorrow. Take care.